G'day everybody, welcome to this chart update and general rundown on the global markets, Australian and overseas markets and all the major indices. Now the volatility did increase quite sharply in the last week in America and that was the case all the way around the world. So it's not unusual for this time of the year, coming to the end of the September quarter, which is typically the weakest quarter of the year. And we're about to enter the strongest quarter of the year, and that is particularly so when there is midterm elections on in America. In fact, only once in the last 84 years has the fourth quarter of a midterm election year not been a positive. Now that doesn't guarantee anything for this year, but it certainly means that the odds are massively in our favour. Now there's also a huge divergence between what's happening in the Australian market and what's happening in the American market, and that's really what I want to examine in this video today. So let's take a look at the S&P, or let's have a look at the details of the S&P first of all. Basically it gave back the previous week's gains, gained 25 points last week, fell by 24 points this week, so a complete reversal of the fortunes of the previous week. And importantly, from a technical perspective, the S&P index broke its 50-day moving average, and it also broke a recent short-term low. So there's definitely a bit of a change in character in the American market. I believe it will be temporary, and once we get into October, that we'll see a resumption of solid buying. That should read solid fundamentals still intact, and they are in America economically and corporately. Things still going along pretty well. Now there's been a really vicious sell-off in energy stocks across the board, not only energy producers, and that includes coal, oil, natural gas, but also a lot of the service providers to that industry as well. And that's really occurred since July, and I think it's based on some old data, and it's not based on current data. I think there was some numbers out about 3 months ago that indicated the demand for energy from China and from other parts of the world was waning. My understanding is that data is now quite old and is no longer applicable. So this is the sort of oversold condition based on a misconception that can bounce back very strongly. But nevertheless, I wouldn't be dabbling in that area just yet. Let's see how it actually plays out. Now, your sector selection is absolutely vital, and I've been talking about this now all year with respect to the American market, where the real advantages are. It's in pharmaceuticals, healthcare, digital technology in particular. So really, really important to stay focused on those sectors. Now, having said that, there's an awful lot of possibilities and opportunities in the American market. There's literally hundreds, if not perhaps bordering 1,000 stocks that fit into that category. So you've still got to have a process, and you've still got to know what you're doing. Now the ASX 200 last week really copped a belting. It's now corrected 6.7% from the peak, and it was down another 120 points for the week. It was a nasty week. The Australian dollar is down 7% in just 3 weeks, down under 88 cents, and it's basically selling from overseas fund managers who are not wanting to get a thrashing on the Australian dollar value of their holdings as well. They've made a lot of money over the last couple of years, and that money is now pulling back to America because the American dollar is strengthening. The expectation is that bond yields will rise, and obviously the Australian dollar is falling and may continue to fall for, look, it's possible it could even dip below 80 cents. I don't believe that level is sustainable, but it could certainly dip to that level. So the selling continues, and I can tell you that the amount of money involved, as I pointed out last week, nearly 40% of our market is made up of overseas money. That is a massive, massive amount of money, and it can't be unwound in just a few short weeks. I believe this selling is going to continue for some time. Now the Australian market, the ASX 200, has lost almost all of its 2014 gains, and the game that's been played, which is the chase for yield in the Australian stocks, was a terrific game. If you're an American or a European investor, you could borrow money at effectively zero interest rate. You can invest in Australian government bonds, or you could invest in our banks or Telstra at 5 or 6% yield, and they made a fabulous amount of money on the yield. They made money on the currency, and they made money on the spread on the interest rates as well. So it was a wonderful game, but that game is now finished, and I believe that the strength in the Australian banks that we've seen, where they've gone to basically historically high valuations based on their yield, is now going to get unwound. Is being unwound now. So I think that chase for yield is over, and there's going to be some significant pain in the Australian stock market. There are also other headwinds for our banks. It's not just overseas selling. There's an inquiry due to be released early next week on the amount of capital that banks have to hold, which would, if it goes through, it's the Murray inquiry, would actually restrict the amount of lending that they can do. In addition to that, banks are also getting attacked on all sides on their transaction fees, and we've now got these new banking products coming in through Apple Pay and a number of other areas. So the banks are really being attacked on all fronts at the moment. So the overall thing, I think fund manager selling will not be done in Australia. It's going to continue for a little while yet. If you're holding banks and you're sitting on some profit, I would seriously consider about taking some money off the table. So let's have a look at those index charts. So we'll start with the S&P, and you can see first thing you need to look at is the red 150-day moving average line. It's still unchanged. The index well above it. So no significant change there in the market. A little bit of increased volatility, but it was encouraging to see strong rebounds on both Wednesday and on Friday. Now what has changed, however, is though that we took out this short-term low. There's a short-term low formed on the 15th of September. That got taken out. The 50-day moving average was broken, and you can see that we have pulled back more than the 38.2% level of this last recent little run. So be interesting to see where the American market goes from here. We've only got 2 more trading sessions before the end of the quarter, so I think we might get back into some more solid trading conditions after that. Turning now to the Australian market, and you can see a very, very significant sell-off over the last 2 to 3 weeks. Now, if we pan back, I've identified a couple of potential support areas with these green bands. Now, all I've done here is put some Fibonacci retracement levels on the various runs. One that started in June of 2013. The next one that started in February of this year. So just taking a line through where those support areas might be, you can see there is one at just under 5,300, which is only just a couple of percent lower than where the market closed on Friday. And then there's another support level down at 50.40, so that would be another 250 points off the index. And the way that the bank selling is unfolding, now let's just have a look at the finance index. You can see very, very heavy selling in the banks. It's entirely possible we could get down to that 50.40 level. So you want to be very, very cautious in the Australian market, even if you're not trading the banks and Telstra and all the major stocks that are being subject to this overseas selling, because what it's doing is it's creating a negative sentiment for the whole Australian market, and stocks that would otherwise be holding ground or going up are actually feeling selling pressure as well. Let's look at commodities. Gold ended up $2 higher for the week, so it wasn't much, but at least it was a slight positive. Now, as we'll see from we look at the chart of gold, it's still within a phase 1 base, but it's forming a declining wedge, which is really concerning me. Now, you remember a couple of weeks ago I showed you that gold had broken an uptrend within that phase 1 base, and I'm just less confident than I was given the way this pattern's unfolding. So this base at 1180 on the gold price would want to hold, otherwise there's going to be some significant selling. So do not try and pick the bottom in gold stocks. It's just not a high enough probability to do at the moment. Now silver comprehensively broke support last week and didn't do anything to reverse that, so silver has been absolutely smashed. Copper, however, continues to be pretty good. It was only fractionally lower at $3.07, but anything over $2.80 to $3 is still pretty profitable territory for a lot of copper producers. So that's still going along okay. Crude oil, despite all the upsets in the Middle East, America is producing so much oil now that there's actually an excess of oil available. So crude oil holding steady around about 93. There's the spot copper chart. Has been trending down over the last 3 months, but still within an overall consolidation. Nickel also lost a little bit of ground, but not a great deal of change there. Let's have a look at the gold price chart. So this is the weekly chart, and you can see that we had a base. We had a base down here at 1180. 1190, which has been tested twice and perhaps about to be tested for the third time. So remember, this is a weekly chart, but you can see we've got declining tops down here. Now you'll notice this dotted line through here. This was the uptrend that we had in gold within this overall phase 1 base. Now that broke 3 weeks ago and has continued down. This 1180, 1190 area would want to hold, otherwise you're going to see a flood of selling coming in, because this declining wedge, which could easily signal a break to the downside. Now, fundamentally, I believe the price of gold should be significantly higher, but at the moment, you've got to say that the trend has a big question mark over it. This is silver. Broke comprehensively through this key support level at just under $19 and slipped away quite sharply down into the 17s. So not good for silver. So just turning to the overall strategy approach, look, investing, as I've been saying all year and particularly in recent weeks, investing in selected US sectors is where the money is. And the divergence between the local stock market and the overseas stock performance is as stark as I've ever seen it. There's normally some kind of cohesion between the markets, but at the moment that is not the case. It's because of this overseas selling, because of our currency has finally cracked, and I think it's got further to play out yet. So if you want to stay in Australia and try and make money here, then yes, it can be done, but just recognise it is so much harder than what it has been. So I believe profit opportunities in Australia will be quite limited until the dollar stabilises, and that could be down in the low 80s before that occurs. Stock prices, they're going to defy the good fundamentals, I believe. They're being sold off on sentiment, and that's just where we're at the moment. So for anyone that would like to communicate with me about, particularly about what we're doing in the American stocks, which are barreling along very, very nicely, then there's my email address and more details on our business on our website. That's it for this week. Cheers.